Good morning, good morning, good morning. Guys, welcome to another fabulous episode of Exit Strategies Radio Show. Hey, y'all know who I am. Yeah, Colvin J. Millette, broker and owner of Exit Realty Low Country Group in beautiful North Charleston, South Carolina. Guys, if this is your first time, as we always say, listen to this show, y'all are in for a treat because our mission here is very simple. That is to, yes, our mission is very simple. That is to empower our community through financial literacy and real estate education, guys. Hey, we are legacy building. Yeah, yep. So hey, today is no different, guys. We have went quote unquote out into the battlefield. We pulled out one of the warriors of this industry, none other than David Stein with First Family Funding. David, how are you doing today?
I'm doing great, Corwin. Glad to be here today with give your audience some good insight into the financial market.
Awesome. Well, I greatly appreciate it. You are a true veteran. All right. So you've been doing this for a while, but I won't tell your story. I'm going to let you do it. So if you don't mind, introduce yourself to
Sure.
our listeners. Tell us about David.
So 26 years in the industry, the mortgage industry. It's been a roller coaster. I've seen it all. Right now, we're in a unique situation, but the market goes through cycles. I've been a previous owner of two mortgage companies up in the Northeast. Moved down to the Charleston area about 9 years ago, believe it or not. Love it down here. The family loves it. Meet great people down here like Corwin and many other people. I love working with first-time home buyers. I have a team of people that work alongside me. We have a great team concept, but we love working with first-time home buyers, especially getting them into their dream homes. But we have products to help pretty much anybody that's willing to buy a home as long as they can meet the guidelines. Credit scores, we have programs with no credit scores. We have down payment assistance programs. We have programs for people that can't show their income. So we have the full gamut of loan programs to help anyone who's interested in buying an owner-occupied house, second home, or even an investment property. Been through these changes that we're going through right now, this market shift, obviously being fueled by things we can't control. The economy is going through a lot of inflation right now. We don't like to say the R word, which hopefully won't be coming. But we've seen these market changes in the past. If you go back 15 years from the crash in 2008, which I went through, again, the market was changing. Things can't stay the constant forever. But one thing that will never change is when is a good time to buy real estate? And my answer is always today.
Yeah.
There's no better time to buy real estate, regardless of where the market is, because it's one of the best investments you can make for equity and wealth building for yourself, for your family. So yeah, we don't know where prices are going to go up or down the road. But if you look over the time, real estate is one of the best investments, just like they say for the stock market. There's never a bad time to invest in the stock market if you're going to be in for the long haul, because the markets will cycle. We're going to see rates come back down probably next year in 2023. Right now, inflation is high. It's causing the Fed to do what they're doing to slow down the inflation. And when people hear that the Fed is raising rates, they think that the mortgage rates are going up alongside with that and hand in hand. And that's just not true. As a matter of fact, the Fed funds rate is the rate that the banks charge each other. It has nothing to do with the mortgage rates. The mortgage rates follow more closely to the 10-year Treasury bond. But everyone sees the Fed, oh, they're raising rates. They just raised them 3/4 of a point last month. We have a Fed meeting next week, the 25th and 26th. They're going to raise them again, another 3/4 of a point, definitely. We may even see a 1% increase to that. But that's all baked into our mortgage rates right now. We knew this was coming. The Fed forecasted what they were going to do this year, and they're not done after July. There's going to probably be 2 more rate increases before the end of the year to tame inflation. And we're going to see inflation come down. We may hit a recession. We'll see what happens. And guess what? When we hit a recession, what happens? The rates come down again, because to fight a recession, we have to lower rates. So the Fed is trying to figure out, the government's trying to figure out to get a handle on this monetary policy. They're trying to, they may have gotten a little late into the game by raising them a little later than they should have. They probably should have done this a little earlier and maybe a little less abruptly. But we're here where we are now, and there's nothing we can do except move forward. You can't change the past. But I tell people, I work with a lot of clients, as Corwin does, that now's a good time to buy. Don't look at what the rate is. Look at your monthly payment.
There you
Your
go.
rate is just a number. The monthly payment is what we qualify you on and what you need to be comfortable with in making your payments each month. You're still going to be better off than renting, because when you are renting, you are paying a mortgage, just not your own. You're paying
Mhm.
that landlord's mortgage. Your interest rate is whatever your rent is your rate, because it's going out the window. Yes, you have a roof over your head, but you're not building anything. And you'd be surprised how much you can afford on a house to equal what your current rent payment is. Just as a ballpark, if you're paying, let's say $1,200 a month in rent, you probably could convert that to over a $200,000 home with
Mhm.
taxes and insurance. But the consumer price index is what drives the inflation numbers, and
Mhm.
they're just rising right now, and that's due to lots of things going on in the world. But they will come down. This is not forever. You're not locked into a 30-year loan forever. There's no prepayment penalties. So your rate today is not going to be your rate tomorrow. So look at this as a way, even if the rate's a little higher than you wanted, as long as your payment is in line with what you can afford, look at it as a temporary situation. And when rates come down, you call us up. We'll be happy to do a no cost refinance for you to get you down lower.
Well, see, consumers oftentimes, David, and thank you for that. The consumers are oftentimes, we're short sighted. When I first started in the business, we always had the conversation about the long ball. Historically, what real estate does over a time period, it's going to fluctuate. But if you're committed to home ownership for the long term, you will see gains, you will see benefit. When I bought the home I'm in now, so it's a second home, first home I bought, the market was running away. So I bought it and it instantly went up in value. Subsequently, it declined steeply. But in the midst of it declining, I bought the second home, which when I bought the second home, it instantly declined in value as well. And not substantially, but it did decline. And a lot of people with the short-term mindset would have been, oh, well, let's, no, you don't want to do that. But now here I am subsequently, the loss that I had, I've now gained 10 times that
Absolutely.
in the past couple of years. Home prices in my neighborhood, my home is worth approximately nearly twice as much what I paid for it in 2009. And here I am like, okay, what am I going to do? But nonetheless, I'm looking at it still from the long ball perspective. So you hit spot on with a number of things, guys. As our listeners, you got to be focused on the long ball.
Yes.
You got to be focused on the fact that rates will change, they'll fluctuate, there'll be some correction, and everything that's going on is simply market. It is simply, okay, I got to pay more to borrow it. Let me see. I might need to loan it out a little bit higher. But when I need to loan money to make money, then I may make some adjustments and fluctuate rates, and other things may happen. So there's a number of factors, guys, that influence, not only real estate pricing, but also the money pricing, the price of mortgages, etc. Now, David,
Yeah.
you guys do, like you said, a plethora of products. You serve a host of people. I mean, it's amazing the depth that you guys, go quote unquote into the bench as it relates to people that you're able to help and serve, from first time home buyers all the way through investors. So let's talk about some of these niche programs, if you don't mind,
Sure.
that you guys have. You talk second home, and there's a lot of people that are looking at, buying a second home, and maybe they may, in the interim, between the time they're here and not, they may, short term rent it or something. What kind of programs do you have for consumers such as that?
So second homes typically run almost like first your owner occupied homes as far as guidelines go on your traditional conventional financing. The only difference is they require 10% down, and the rate's a little higher because
Mhm,
it's a second home. We also have other programs for people that may not qualify traditionally, whether it's
mhm,
a second home, even an owner occupied home, and for investment properties, especially for a self-employed borrower. We know a lot of self-employed borrowers have to pay Uncle Sam on their tax
mhm.
returns each year, and they have very creative accounting, and they like to pay as little as possible, as would anyone, to the government. So they minimize what they show on paper, not meaning that they can't afford anything, their credits are great, just what they show on paper. And unfortunately, in our world of underwriting, we can only go by what we can see improve. And typically, a lot of self-employed people don't show enough on paper to minimize that tax. So, as an alternative, we have a few programs, again, owner occupied second home or investment property, where we can use your bank statements and the deposits in your bank statements as your income. So, what we do on those types of programs is if you have a business bank account, we'll take your business bank account, we'll add up all your deposits that you've made. Obviously, no transfers between accounts. It's got to be true deposits, income into the business. And then we'll divide that by 12 or 24 months, whatever is necessary. We can average it over 12 or 24 months, whichever is a better number for the borrower. And then we apply what's called an expense ratio to that, depending on the type of work you're in. The floor on the expense ratio, or the maximum we'll ever charge, is 50%, and the minimum is 20%. So if you're a sole proprietor and you don't have office space, you're working out of your home, let's say you're a consultant and you have no employees, then we'll be able to use 20% for your expense ratio, which means we'll take 80% of those deposits, divide that by 12, and whatever that number is the number we put in your income. So just like any full documentation loan, if we were using W-2s, tax returns, or pay stubs, whatever income we calculate that goes on the application, we use a number from the bank statements instead. So that's one way to qualify for an alternative way of qualifying. We also have, for owner occupied and for second homes, the ability to do what's called a no ratio loan. We're one of the only companies down here that is offering this product. And what that means is we don't look at your income or your employment at all. It does require a larger down payment, 25% down minimum. You have to have decent credit scores, at least a 660 score. But we won't even put your employment on the application. We won't even list what you do for a living. We won't list your job income. And we just qualify you based on credit score and what we call loan to value, putting that down payment down. So that opens up a lot of options for some people who are in unique situations. Especially, we have a lot of people that come down, just like I did, from the Northeast, want to move down to our great area here in the South Carolina. But you have some challenges when you're moving. Where your job is in the Northeast. I don't have a job yet down in South Carolina. I'm going to get one. I have no problem in thinking I'm going to get a job. But for us, we need to have that job in place to be able to qualify you. So we use this program for a lot of people in that situation, because here you don't have to show your job. So we don't care where you work. We've used that program for people that are married, where one person has a better credit score than the other person. And if you use them together, they don't qualify. So we take off the person with the bad credit score, use the good one, and do the no ratio program. The only difference on these programs is the larger down payment. You can't do a 5%, 10% down. So it limits who can use these programs, but they're available. We close them every month. We do a lot of business in that program. And then lastly, for investors, we have what's called a debt service coverage loan program that we don't use your income. We don't require your tax returns, pay stubs, or W-2s. You don't list your income. You do list where you work, but you don't have to list how much you make. And we use the debt service from the subject property you're purchasing to calculate what your mortgage amount would be. And you can do those with as low as 20% down. So a property that is self-sufficient, let's say, we're getting rents of $3,000 a month in, and my new mortgage payment with everything, taxes, insurance, principal, and interest, is going to be $2,500. Then my debt service coverage is in the positive, probably around 1.2. Let's say your rental income is $3,000, but your PITI, your principal, interest, taxes, and insurance, is $4,000. We're kind of in the red there. We still can do that loan. The rate will be higher, and the loan to value will be lower. So they require more down payment on something like that, but we still can do the loan. We have a lot of people that buy houses now as investments, and they Airbnb or VRBO them.
Yep.
Now, we can't use those rents. You're going to get very nice rents, but if you Airbnb a property, because you're doing nightly or weekly rentals. So you're going to earn a lot more money by renting it that way than if you did a 12-month lease with a tenant. But we can't use Airbnb proposed rents. So we can only use what the appraiser is going to tell us what market rent is. So we do have a lot of clients who buy these properties, even though they're technically underwater on paper, but they know that, hey, I'm going to make $8,000 on this a month. I
Mm-hmm.
don't care about, these other issues. I
Mm-hmm.
want this property. So we have a lot of creative programs to help everybody, regardless of the situation. Credit score, down payment really drives what's available. The more you put down, the higher your credit score, the more options you will have available to you. The lower down payments and the lower credit scores, we still have options, but they may require more down payment than you can afford at this point. But we have the programs available, even with people with scores in the 500s, 400s.
Mm-hmm.
We have loan programs for them if they can meet those requirements of the larger down payment and can afford that monthly payment. And most of those clients that I deal with that do those types of programs, these are what we call Band-Aid loans. I had an issue. I had a bankruptcy. I had a foreclosure.
Mm-hmm.
And then the more time that goes by, the more programs they qualify for. We have programs for people if they're one day out of bankruptcy, one day out of foreclosure.
That's
They
huge.
have a large down payment, higher interest rate, but we'll get them into the house. And then guess what? 2 years later, we can do a refi and get you into lower payments. So lots and lots of different programs available for any type of borrower, regardless, owner occupied, second home, investment properties. Investment properties are very hot right now. That Airbnb market is just blowing up. And Corwin, a lot of your clients that you sold houses to in the last couple of years have seen tremendous appreciation in
Mm-hmm.
their homes. As a matter of fact, Zillow came out this morning with an updated forecast of, and this is for the country, not just our area. Our
Mm-hmm.
area is probably a little higher than this number, but for the country, they're anticipating house appreciation of 14% this year.
Yeah.
They were higher at the beginning of the year, but they just came down. But still, 14% appreciation. What does that mean? If you don't buy today, you're missing out on appreciation. Don't be short-sighted on a interest rate or a payment today and say, I'm going to wait for rates to come down, because even if the rates come down, your payment's going to go up when you have to buy the house that's 250,000 today and it's 300,000 in 6 months or next year. So all that waiting time has cost you dollars in your pocket in equity. So
Yeah.
it's a real important factor when you're considering purchasing, because it's not about the monthly payment. It's not about the interest rate. It's about, like Corin said, the long ball. Where are we going to
Yeah.
be in 10 years? And in 10 years, that house will appreciate. I guarantee you.
Yeah. Yeah. And you touched on some things in there, obviously, David, that are, we always try to stress to our listeners. We talked about this on our show a few months ago, early part of the year, about the difference, year over year, Charleston last year to this year, or it was a study that was done during the middle of COVID, how rental prices increased and also how the market increased. And we saw double-digit increases in values during that time period. It is amazing to me to even fathom that we're going to experience something similar to that yet again, because home prices, I mean, we're already in the Charleston market. I mean, I is amazing to me, when I look at it from what I remember when, quote unquote, when I started in the business nearly 20 years ago. So that's obviously, it does bring about some challenges, quote unquote, to some, but for others, it makes no difference because they're coming from markets where home prices are well past average, well past 500,000. So to come to a market where, okay, it's just 500,000, is definitely an eye opener for many people.
Yeah, one of the statistics that I just recently read in the Charleston market is in the next 5 years, house prices should be about 30% higher than you buy today. And that's a current statistic. That's not, something that they've talked about years ago. This is, recent statistics. So if you purchased a home at and the median price, I think, in Charleston County is $717,000 right now. If you purchase a home at 717 right now, in 5 years, you're going to gain 200,000 plus in equity. That's a big number. Where else can you do that?
Yeah, it
So,
make your head hurt.
yeah. And if this is an owner occupied property, people think, oh, I got to come up with 20% down. It's not true. We have so many loan programs with 3% down, 5% down, and our down payment assistance programs that will cover 100% of your down payment that are available. and score. You don't need a high score to get into these programs. 640 minimum score is all you need. And we can provide that down payment assistance, whether it's coming from our partners at SC Housing right here in South Carolina. And we have other programs that are offered throughout every state. It doesn't have to be a South Carolina housing program that offers these down payment assistance for borrowers. And then we also have those VA programs, no money down if you're a veteran. We love to help our veterans. And also USDA. USDA is a big misconception out there. Everyone thinks, hey, if I'm going to buy a USDA property, it's got to be on a farm or a really, really rural area.
Yeah.
Not true. USDA has these tracts of land that they've designated to offer no money down financing. There is an income limit requirement for the borrower at the same time, unlike VA. But all you have to do is go to USDA.gov or USDA.com. I forget which site it is, and plug in an address, and it'll tell you if it's eligible. You'd be surprised how many houses are eligible for this type of financing, which is great financing. No money down. You do have to cover closing costs unless Corwin can work some nice magic with seller concessions. Get the seller to pay your costs.
Yeah, that's speaking of that's crossed them contracts right there.
Right there. And we literally, and I've done it many, many times, have gotten people into homes with no money out of their pocket, believe it or not. And people think, oh, it's only for a few people. No, there's lots of products out there for the everyday person. And the down payment assistance is something that's available for many people. And they just don't realize the biggest barriers to buying homes is usually down payment and credit. Yeah. And we have solutions for both of those. We have credit repair companies that we partner with to help people that do have some challenge credit to get them ready to buy a house, whether it's today or in 3-6 months from now. And those down payment assistance programs really help out the people that are challenged on that piece. So, we're here to, help serve the market. We love helping people get into homes. That's what we do. It's our passion. Like I said, 26 years in doing this, and I still love coming to work every day, helping people, helping your clients. And homeownership is the dream. That's what everybody aspires to. It's pride of ownership. You want to own your own home, provide for your family, but more importantly, and I know, Corwin, you're a big proponent of this, is wealth building. Yes. This is how you help people build wealth for their future and their kids, because there's no other investment that's going to appreciate as much as this with the low cost of entry, where you're not having to throw a boatload of money into an investment vehicle to make money. Here, yes, you're buying a house. It's very expensive, but we can help you get into it at least with the least amount of money out of your pocket.
Well, we got some function in this, and David, listeners, we get to the end of the show, but I want y'all to take this with you. We got function in home ownership and building wealth. If we were buying stocks of Tesla, Apple, Amazon, all these stocks that are trading now hundreds, if not thousands of dollars per share, you don't have any function in that. You don't get to use that Tesla stock. It ain't like you buying a share.
You don't get the car.
You got a Tesla. No, that's not how that works. What you get with a home is that you get function. You get to use the space, the place, and in turn you get to build and accumulate wealth in the process. That is amazing.
So right, David, if you're not paying a monthly mortgage payment, you're paying a monthly payment most likely in rent. So that money's out the window. So spend it on yourself, build that wealth.
Exactly. Dave, if you don't mind, give our listeners your contact information. Where can people get you?
Sure. It's David Stein with Family First Funding. We're right here in Mount Pleasant. We are licensed in over 38 states right now, so we can help you whether you're here or moving out of the state if that's your desire. I can be reached at 843-375-8434. That's our direct line. Or you can just go to Family First Funding, Google it, and our website will come up. You can apply online. You can inquire online at any of our websites that are out there.
Awesome. Well, David, again, thank you so much for joining us today. Thank you for that insight, for the information. Our listeners, guys, we've had an amazing show. It has been a blast. As we always tell you, guys, please, please, please make this week about someone other than you. Help someone out there in the community. Help them to be better. Help them to achieve, so we all achieve more together. Guys, you know what I say. I love you. I love you. I love you. And we're going to see you guys out there in them streets.